Trent Bradshaw with Bradshaw Financial Planning, and thank you for joining us for Mind Your Money. Today is June 18, 2020, and thank you for joining us for this market update. What we're going to jump into as far as the agenda today and talk about, we're going to look at the three indices that are normally followed: S&P 500, Dow Jones, and also the NASDAQ. In addition to that, we're going to look at housing, positive data points there, and then last, we're going to talk about that Fed balance sheet and why it's so important. And actually, what were some of the headlines from earlier this week? All right, let's jump right in. Let's take a look at the S&P 500. What you'll see on this chart is we had a crossover of the 20-day moving average over the 200-day moving average. From a technical standpoint, very positive. So we were glad to see that. Now, one thing we're looking at in the short term is we start to have some weakness here, and it's called the momentum indicator. It's called the MACD. Well, what it is, short term, more money's flowing out of the market than coming into the market, and that's why we had that crossover. And you may be able to see it a little bit better on this side right here. We're keeping an eye on that, but in addition to that, the accumulation distribution of money coming in, going out, obviously has slid also. We've got to take a look at that and consider what kind of impact that's going to have on the S&P and the general market as a whole. We'll keep an eye on it, but longer term, that is a positive. Let's take a look at the Dow Jones. Dow Jones, very similar chart. The one thing that I will point out, there's a lot of financials and also some defense stocks that make up the Dow Jones. Those particular industry groups have been under pressure, specifically Boeing. Boeing, with the 737 MAX issue, obviously has been a strain on the overall Dow as a whole. But we haven't had that 20-day crossing the 200-day either. So that positive point that we had on the S&P 500 is not there for the Dow. In addition to that, we'll look down here at the momentum indicator called the MACD again. We had a crossover in the short term, and you can see it better over here. Obviously, if you'll remember, last Thursday we had about an 1,800 point correction in the Dow Jones. Brought back the volatility of what we saw back in the March and April time frame, but that caused the crossover at that point. We're definitely keeping an eye on it. Accumulation versus distribution, there you go. Still going down. That's another negative sign. So in the short term, has the market ran out of steam? Well, let's look at the last index, which is the NASDAQ. Much more positive. So when you look at this, we actually had the crossover in regards to the 20-day crossing the 200-day a few weeks back. When that occurred, the NASDAQ obviously is the best in-shape index that we're looking at from a technical standpoint. The NASDAQ has a lot of technology stocks in it. Those technology stocks have a tremendous amount of cash on their balance sheets. That's really where you want to be during this type of market with some volatility. In addition to that, we'll look at the MACD. Obviously, we've had some weakness. You can see it better here. That MACD in the last week, of course, we had the correction last Thursday, has crossed over in the short term. That's a negative. But the accumulation and distribution line, money flow in and out of the NASDAQ, is flat, which means it's even. So even though we had a major sell-off last Thursday, the NASDAQ's still holding up pretty well. You got to remember, there's roughly 4 or 5 companies that make up about 20 to 25% of the overall NASDAQ index. So those 5 companies are carrying the load of what we're seeing. But it is a larger exposure inside of our portfolios at this point. Next chart, let's talk about housing. We've got some positive data points. We just got the latest mortgage application or purchase applications data. What you'll see is an increase of 17.2% in the latest month. That is fantastic because we were down almost 30% back in the April time frame. All right, are we recovering faster than expected? Maybe so, and that's a good thing. But the fact of it is, home ownership, construction make up about 15 to 18% of our U.S. domestic product every year. So that GDP, that growth that we see every year, 1/5 of it's made up of this. And if we're getting a quick recovery, that's an outstanding data point that we want to see. Last part, let's talk about that Fed balance sheet. The Fed's still pouring about $4.5 billion into the overall bond market on a daily basis, so about 120 to 150 billion a month. They're buying mortgage-backed securities and also U.S. Treasuries. That's providing a backstop to the debt market. The equity market interprets that as a positive. But this past Monday, the Fed even committed to buying individual junk bonds and also individual corporate bonds, providing even more liquidity. Like I said, the market loves it. But look at this latest headline for Monday. The Fed's bond buying is boosting the market. Imagine if they bought stocks. I wouldn't put it past them. We'll have to keep an eye on it. But right now, with all the liquidity pouring into the market, we do have equity exposure. If you got any questions, concerns, please give us a call, shoot us an email, join us on social media, but also join our YouTube channel so we can bring you these updates. This is Trent Bradshaw with Mind Your Money and Bradshaw Financial Planning. I hope you have a wonderful week. Look forward to speaking with you soon.